Good morning, good afternoon, good evening, everyone. Welcome to another episode of Smoking Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of being joined by Canoe Financial and one of their portfolio managers, Nicolas Papageorgiou. Before I turn it over to Nick, I want to introduce one other speaker that we have today. He's a returning guest. His name is Wayne Myers. He's the district vice president for the Calgary and Edmonton area. And Wayne is a key support person to our team here at Tower Wealth. He aids us in understanding the Canoe Financial products, and he's been a great support to us and also helping bring this podcast together. So before I butcher any introductions to Canoe or to Nick Papageorgiou, I'm going to turn it over to Wayne and let him introduce Canoe and the team over there. Thanks again for being here, and maybe you can introduce yourselves better than me.
Great. Thanks, Tyler and Dave, for putting on a podcast like this and including us in it once again. For those of you who do not know, Canoe is a Calgary-based and founded asset management firm. We are active. We're independent. In fact, we are 100% employee-owned, and we are very focused on providing top-end solutions to Canadians. We are one of Canada's fastest growing investment management firms today, with over $19 billion in assets under management. One of the tenets of what we try and accomplish is to provide very good risk-adjusted returns to investors. And one of the advantages we had a few years ago was we were able to come across a group of defensive portfolios that we were able to bring that provide equity exposure and the upside of equity exposure, but at the same time have a risk management overlay that allows us to minimize the downside of that equity exposure, essentially providing balanced-like metrics in an equity fund. Today we have Nick Papageorgiou, as Tyler mentioned, to discuss more of the details around that risk management overlay. Today we will not be discussing the equity portion. It'll be based on the risk management overlay. Nick has over 20 years of experience in the industry. He's been a derivative strategist and a director of research in the past. He's also been the chief investment officer of a major Canadian investment management firm. So without further ado, why don't I pass it back to you guys and maybe Nick to do a quick intro of himself.
That's great, Wayne. Thank you. So Nick, thank you very much for being here and joining us for the first time on the Smoking Bulls podcast. Maybe we can take a minute just to introduce yourself and a bit of your background, and then we can jump into your role there and what it is that you manage with Canoe.
Absolutely. Great. It's good to be here. Thanks, Dave and Tyler, for having me on the podcast. My quick word on my background is obviously my background is initially I was an academic for many years. So as you'll see when we talk about some of the stuff that we've developed, it's a lot of it is research based. It's things that we've developed over many years through some proprietary research that we've done. So my early career was an academic. I was a professor at the university for about 15 years, but I always had one foot in the private sector. So I was ever since pre-crisis, I'd always been involved with different asset management, different groups in the private sector, and trying to implement some of the research that we've done in the academic circles. And as Wayne mentioned, that led me to taking on the position of a CIO in a large asset management firm. And it's been a couple of years since I left there, and it's been very exciting now to be able to refocus back on the R&D side of the work and the implementation of strategy. So we've been thrilled to be working with Canoe for over 7 years on this strategy, and it combines for us a really interesting kind of fundamental bottom-up approach with a more quantitative overlay strategy that we have developed over the years, and I look forward to sharing with that with you over the next kind of half hour or so.
That sounds great, Nick. So yeah, why don't we just jump right into it? You manage a defensive overlay for Canoe, and maybe you can describe a bit about the dynamic nature of volatility and how what you're doing provides, a safety net almost to something that would be considered, having a risk profile to it.
Absolutely. So I'm going to be mindful not to turn this into a stats class, right? But I am going to briefly take you back. I'm briefly going to take you back to high school here, guys. All right. So I think when we think about investments, we think about them in two dimensions. We think about risk and returns, and returns are kind of easy to get your mind around. It's kind of what it's what you expect in terms of your return on the capital you invested over time, and you hope that compounds nicely over the long term. The risk, at least in public markets, we generally think about it as some form of volatility, some form of standard deviation of returns. How certain are we about that point estimate that we have, that 10% expected return? Is that going to be ranging from 8 to 12, or is that ranging from minus 10 to plus 40? So the standard deviation kind of gives you the confidence that you have in that point estimate. And generally, when we think about investing, we just have those two data points: the risk and the return. Our concern is that the risk component is not at all static. And we use that to define the kind of loss thresholds maybe that we're willing to put up with, or that we're willing to accept. But what we don't realize is, we don't account for, is that volatility, that risk is greatly variable over time. And that often leads to disappointment in terms of the outcome, because the frequency and magnitude of losses are suddenly inconsistent with the assumptions you make. Right? And that leads to bad behavior. When you're suddenly faced with something that didn't work out the way you expected, at least in the short term, you tend to react in a manner that's maybe suboptimal for your long-term capital accumulation. So what we like to do is to kind of manage the volatility of volatility. And if I could put up a couple of slides, maybe to help explain a little bit, to give some color to what we're doing.
Yeah, you bet.
Yeah, I'll do that. It's here we go. If I just pop that there, I'm just going to pop 2 slides down. Can you see that? So this for us is a representation of uncertainty, if you like, of risk. The blue line. This is short-term volatility. It's actually the VIX index. So some of you might be familiar with it. It's the implied volatility that's priced into options markets. It's essentially what they call the fear index. So this is something you could observe in the market. It's a short-term volatility measure, and that's that blue line that's kind of moving around over time. The average of that is the red line. So if we're assuming volatility is constant, you're kind of assuming volatility is at 18% over the long term. That's a fair assumption, and on average, that's where it is. However, you could see that over periods of time, the volatility moves around tremendously. This is what we're concerned with: is that when market volatility is low, the amount of risk you're taking is actually pretty consistent with your assumptions, and then you have these periods of higher volatility where your exposure to these tail events, to these larger drawdowns, is much more significant. And what we're trying to do is ensure that during those periods of higher volatility, we're going to start dampening your exposure to the market, so that the exposure and the risk that you take is more consistent with these long-term assumptions. And what's interesting, I think there's 2 interesting takeaways if you look at these graphs. One is obviously the volatility is clearly time varying. So you can see that vol moves around a lot. You have periods of low vol, and those periods of low vol are often periods during which the market does very well. Bull markets are characterized by low volatility, right? And those bull markets are then punctuated with periods of high volatility and corrections. And you can see that from in the 90s there was a tremendous bull market, and the blue line, which is the short-term volatility, is below the long-term average. Everything's going smoothly, market's ticking up, volatility's low, everything's hunky-dory, and then suddenly the late 90s and early 2000s, long-term capital management, Asian crisis, the default on the ruble, .com. You have a period of high volatility and great underperformance in the market. So you have periods of downwards markets and higher volatility, and then once again, 2003 to 2007, volatility drops, and we're in another bull market. So again, everything's kind of going up in a nice organized manner, and then we get hit with the global financial crisis where vol spikes again. And again, significant drawdowns, and this pattern repeats itself. Great bull market from 2011 to 2017, and then COVID, and a huge spike in vol and drawdowns in the markets. And what we're trying to do is create an environment where we want people to be invested in the long term. It's absolutely fundamental to grow capital over the long term. You must stay invested in the market. However, the it's not just about the destination, it's also about the trip. If you're a multi-generational investor, the trip is less important. Pension plans, institutions, they have a time horizon that's, you can count in generations, and often these little blips are opportunities to buy. If, however, your horizon is one of 5-10 years or even shorter, well, those drawdowns become extremely important to manage. And that's why how we intervene essentially is to come in and manage those changes in volatility, those spikes in volatility, ensure that the risk of the overall portfolio is properly managed, so that the accumulation of capital and essentially through the mitigation of drawdowns is maximized over time.
Can I interrupt just a second there, Nick?
Absolutely.
You're talking about volatility. Does volatility, in your perspective here, determine the end of a bull market? And is that volatility often event-driven, or is it overvaluation driven?
So it could be both. I think for us, volatility is to be very clear, we're not looking to forecast returns. Okay, now there is a link between returns and volatility, as you can see there, but our goal is not to forecast whether the market's at a peak or whether or not returns are at an inflection point in the market. What we're really trying to do is manage kind of the risk exposure, the dispersion of possible outcomes, and keeping those kind of keeping the bounds around those a little bit tighter. When you get to the end of a bull market, sometimes, and every bull market's different, sometimes you will have this acceleration, this kind of little frenzy, this FOMO that characterizes the end of a bull market, which you'll have the volatility build up. And we saw that in the financial crisis, we saw that in .com crisis. You had this acceleration of returns, which also leads to an increase in our measure of volatility, right? So in those cases, it runs into the volatility measure. We start hedging as that volatility measure increases, and that then it does, in certain circumstances, become a good predictor of market peaks. It's not always the case. So we try to dissociate ourselves from the forecasting of returns. We try to make sure that we're always positioning this as a tool for forecasting volatility, so that we have a good understanding of the level of risk in the portfolio, in the markets, and that's always controlled at a level that is kind of consistent with what we feel this type of product should be carrying in terms of risk.
Got it.
So I guess when you're running this overlay, what are the keys to success? Like what are you implementing that lets you achieve the lowering of volatility?
So again, for us it's identifying these patterns in volatility, and for us it's about modeling volatility at a very high frequency. So volatility is a mathematical construct, right? There's hundreds of ways of calculating and measuring volatility, and so what we've worked on over the years is methods not for just calculating volatility, but for modeling volatility and being able to forecast volatility in the short term. So where is it heading? And that for us is the key component. Being able to parse data at different frequencies, include that in a model that allows us to forecast both the direction and the speed at which we expect volatility to change. Right? And once we have that information, well, we will make adjustments to the portfolio, and we will discuss how in a few minutes time, to ensure that the level of risk is consistent with with what the investor ultimately wanted, and the types of drawdowns they're potentially comfortable in incurring. So for us the key is always being able to hedge those changes in volatility. It's not a perfect science, but there is a science to it, right? And there's this goes back 30-40 years. The research that started in volatility forecasts, Engel and Granger had won Nobel Prize for their work on this, and over time, as data and computers have become more powerful, and the models have become more powerful, it allows us to consume data at a higher frequency, to build more sophisticated models, and to have this forecast that allows us to get a sense of where the risk is going. And that's what we're trying to do. We're just trying to manage that risk so that the capital accumulation process is smoother, drawdowns are managed, and we do it in a systematic manner so that emotion is taken out of the equation.
Thanks. So basically, when you're, I mean, the ultimate goal is to achieve a similar rate of return as, comparable funds with less volatility.
Absolutely, and again, it's about ensuring that the people stay invested over the cycle. So if we could get to the same destination without incurring the kind of volatility and drawdowns that another fund has, then it greatly increases the probability of the investor staying invested over that time period, right? And I've got a little, actually, I'm just going to flip forward one slide here. There's, when we talk about behavioral finance and behavioral behavior that is detrimental to the accumulation of wealth. So this is a kind of just a simulation, if you like, of how, from a behavioral perspective, investors react in drawdown periods. When markets are going well and everybody's invested, everybody's happy, and you're watching your portfolio tick up, and there's a ton of optimism. As volatility increases or markets start to get drawdown, there's a little bit the fear factor that comes in, that behavioral component. Historically, we like to think of markets being efficient and people being rational. We know that's not the case, right? But people have emotions. We all have emotions. We all react to what's going on in our portfolio, to what's going on in the markets. And as markets tend to draw down, if you don't have some kind of risk management overlay, well, the blue line's the market here, kind of how the market reacted. And this is, you can think of COVID. It's a very similar pattern here. Well, most investors, or a lot of investors, I would say, as the market comes down, will suddenly get out at the wrong time. As markets are coming down, they'll kind of surrender and give up before the market hits a bottom. But the issue is that they're not going to be invested when the market comes back up. So you've pulled out, you've taken a hit, you've divested from the market, and then it takes you a while to get back in. So the brown line is the investor who's kind of taken that first hit, is a little bit hesitant to get back into the market, and slowly over time reinvests, but ends up greatly underperforming over the cycle because they pulled out at the wrong time and then they were hesitant to get back in. And this is typical behavior that you see with a lot of investors during periods of significant drawdowns. Now, if you could just reduce that drawdown, and that's the goal of the RMO, is to kind of temper the drawdown, so that sure, we're not going to turn a negative market positive, but if you could reduce that downside capture to 50, 60, even 70% of what it was, well, it allows people to sleep better, to not make bad decisions during those periods of crisis, to stay invested, because during those periods you will be outperforming during the drawdown, and kind of gives you that comfort that, all right, even if you don't get 100% of the up market afterwards, and you only get 85 or 90% of it, well, on a compounded basis, you might be better off. And even if you're not better off and you're just the same, well, you haven't gone through the anxiety and potential potential error of pulling out at that worst time. So what we're really trying to do is manage the downside risk, but at the same time, we don't want to be a huge drag on the portfolio. So it's about ensuring that the hedge that you have on during periods of great calm has to be minimal, but you need to be ready to step in and put on a more significant hedge during periods of greater uncertainty. And if we could get that downside capture to 60, 65, 70%, and you can maintain 85 to 90% of the upside capture over the long term, you're going to be much better off, and you're gonna have a much smoother trajectory to that final goal.
All right. I guess maybe you have an example for us of an action.
Sure. Let me just skip ahead. I got a couple of examples here, actually. Here's actually the COVID. This is the RMO strategy during COVID. Just to give a little bit of a color here, the brown line that you see, the dotted brown line, that's the VIX index. So that's basically the uncertainty that's being priced in the market, in the options market. So this is kind of what you see, the insurance, if you like, in market being priced at on the for the index. And in blue, you have our hedge ratio. So our hedge ratio, if you like, you can see it on the left axis here is the hedge ratio. On the right axis is where the VIX is trading. So you can see that in February, the hedge ratio was relatively small. It was around 8, ranged from 8 to kind of 15%. But it started to sneak up in February before the market drawdown in March. And this is because we were picking up, and some of it stemmed from even January. You can see that the hedge ratio was around 20%. There was some noise, some volatility, some uncertainty that was already manifesting itself in the market in January, February. And our models were picking that up. And as we got into kind of late Feb, the hedge ratio started to increase. Well before the insurance, it's a question of days, but it's significant in terms of forecasting ability. You can see that the hedge ratio came up before the market started to price in this uncertainty. And so over time, we had a 30-40% hedge, up to 55% hedge on. This I believe was the hedge ratio from the international defensive strategy. And you could see the hedge ratio was up to 50%. So it protected on the downside, and I'll show you the slide with the performance numbers right after. But what's also important is that our hedge ratio, because of its dynamic nature, also started to reduce relatively quickly before the VIX dropped, before the market uncertainty in general started to lower. Our hedge ratio actually started to come down. So our models were telling us at this point that our forecasts of volatility were decreasing. Even though the market was still pricing a relatively high level of volatility. So when you put all of that together, what it means is that from a performance perspective, sorry, just can see the numbers here. I just got to move the little picture here. So you can see the fund over the period of time that we're looking at here, Jan to end of May, end of Jan to end of May, the fund was actually up 2.1%. Right, the benchmark was down 8. So overall, there was a 10% outperformance. Some of that came from the stock picking as well. So we have to, we have to be to give everybody their merit here. But you can see that the downside capture was 41% during COVID for the International Defensive Fund. The peer group average was 106%. So that means if the market went down, the index went down 25%, the peer group went down 1.06 times that, a little bit more than kind of 26.5% was the average peer group, whereas the defensive international went down 8%, right? 40% downside capture. And so when, first of all, you don't have the drawdown, so you're feeling good about yourselves, mid-March already. And then obviously as the markets pick up, the hedge ratio is relatively quickly removed. And you manage to participate in the upside as well. And that's kind of something that over the years we've done a lot of work on, not just getting the hedge on, because getting the hedge on is one thing and it's important. But if the hedge stays on for too long and you give up everything when the market recovers, then it's a little bit unfortunate, obviously. So you want to make sure that you get the hedge on. Our primary goal is to protect capital. Right, so we want to make sure that as markets become a little bit more volatile, we're there to protect the capital and create a better base, a solid base off which we could build off afterwards. But it's important that we don't overstay our welcome as a risk manager in the sense that we want to get that hedge ratio off.
Yeah, that's important. I mean, you kind of want to draw people back to that time and remember what it was like in March when, governments around the world were shutting down economies and saying everybody had to stay home. Markets are tanking incredibly fast. To have the conviction to say, okay, we can go risk off now, as early as you did, and are suggesting that you did, that's tremendous, because at that time there was so much uncertainty and the VIX showed it.
Absolutely.
but it wasn't happening. The markets were snapping back so quickly. It was almost mind-numbing to go, what the heck did we just go through here? Like March was cratering, and then we were coming out of it, pulling out of it like a jet.
It was it was an incredible recovery, and that's one of the things that go over time that as we've first, these models are continuously evolving. It's not something we've built, we've plugged in, and that's finished. Like it's a continual R&D process, and that's one feature that we managed a similar type of strategy back in the crisis, and it had done fantastic in protecting. But because we had been targeting a much more constant level of vol back then, our time to get the hedge off was way too long. So 2008 we looked great. 2009 we didn't look so great. And so the dynamic nature of the hedge in both directions, getting it on and getting it off, is something that we've done a lot of work on. And one of the aspects that we looked at, without meaning to get too technical, is how negative and positive returns feed into our volatility model. They don't feed in the same way. So a negative returns, so at the beginning of a crisis, we're very sensitive to these negative returns. So our hedge ratio is going to be more aggressive in terms of how it's going to increase the ratio. However, when returns are positive, if you have big positive returns, because volatility shouldn't see positive or negative. It sees the square of that, right? So everything's positive when you think about volatility. But what we do is we adjust those positive returns in a manner that the measure is less sensitive to them, right? So a sequence of larger positive returns will not affect us the same way as a sequence of negative returns. And that allows the hedge ratio to kind of remove or reduce itself more quickly as markets recover. So all of these is done obviously with we consume a lot of data and at relatively high frequency, but it's important that these little features of the model and the sensitivity to different environments are things that have evolved over time and allow us now to have something that we feel is can achieve obviously the downside mitigation that is absolutely crucial to what we're doing, because you don't want to have the type of error where you're not there when the market collapses. That's got to be our primary objective. So I'd rather be wrong and hedge something that doesn't come down than be wrong if I don't hedge something that does come down. A market that does correct. That for us is so we need to be mindful of being there when the market's correct, but also about how we're going to step out when they start to move back up.
So when you're using and looking at this, obviously you're working with Canoe's equity managers, and so things like geopolitical events, economic events, in your world, I guess they're already priced into the volatility of the markets. It's not specific events. You're looking at all of the volatility, and that's how you're making some of your decisions. Whereas the equity managers are trying to take in these geopolitical and economic things. You're providing them with just your complete volatility look on, regardless of what has caused the volatility.
So absolutely. So we're looking at vol on an aggregate basis. Absolutely, right. So the managers and in this case, the manager that we work with on this strategy, Pinestone, they are a quality, fundamental, high conviction, long-term, low turnover manager, right? So they would argue that maybe their names are less sensitive to geopolitics, but there's always some sensitivity there. So they do a bottom-up build of their portfolio. The last thing we want to do is interfere with anything that the manager's doing. You have a top decile manager who's done a tremendous job of adding value over the last 10, 15 years. The last thing we want to do is interfere with them. So they have their process. Some of it might include geopolitical risks within their investment process. But the last thing we want to do is interfere. So what we do is we work independently from them. So they manage the stock level, and what we're going to do is on the index side. So we'll manage through index futures and index options the volatility on an aggregate basis. So absolutely, what you said was spot on. We're not going to try predict geopolitics or any kind of stock level or sector level volatility. We're looking at it on an aggregate basis. We're aggregating a lot of information into these forecasts, both in terms of stock index level information, volume information, who are the participants in the market, are these hedgers, speculators. So there's a lot of information that we aggregate up, but ultimately it comes down to index level high frequency data that we then kind of plug into our models, and we don't trade at a high frequency. So that's important. We're not looking to take advantage of very short-term moves in volatility, but we're assimilating all this information and then building that into our model, which is telling us how to position basically for the next day or so.
Thank you. That was good.
Nick, I don't know how many slides you have left or other things that you want to touch on, but can you speak to the current market environments and what volatility is like right now? I mean, we've been in what we would consider to probably be a bull run for a year now. And, are we waiting for that next geopolitical event? Are we, what's going to trigger what everybody wants to know, right? When should I get out of this?
Absolutely.
So what are you guys doing? Or can you even speak to it? I guess.
It's a good. I'm gonna answer your question, but first I'm gonna give you a little bit of background on another example, which is gonna lead me into answering that question. Okay.
Okay. Great. Yeah.
Give me a little bit of latitude here. Right?
Yes, of course. Yep. I didn't want to skip too far ahead.
No, for sure, absolutely. Because there's a lot of there's a kind of a bit of a similarity between the example that I'm going to do now and I think what's going on in the markets. It's a different market than August 23 today, but from how we're seeing, it's there's a few similarities. And even before going into August 23, I'm going to take one further step back, and I want to just describe. So we when we hedge. Our strategies, there's two things that we use. I mentioned futures and options. Most of the time we just use futures, right? Futures are great for us because they're extremely liquid. They allow us to put a hedge on extremely efficiently. They're very cost efficient, and they don't cost anything to carry. What do I mean by that is that if you buy or sell a futures contract and the market doesn't move, it costs you zero, right? If you're using options, which is we do sometimes, and there's a time decay to options. So if you buy options too often, and options are great for protecting portfolios and it's a great source of insurance, but there's a cost to holding options. So if the markets don't move or the markets move up, the option just decays and it loses value. So it's very costly it's more costly to hold options, and so it's not something we do often. But you can see in the graph here. The blue part, whenever it's blue, it's a hedge ratio that's implemented with options. And the little beige areas is when we use, the blue is futures. And the little beige areas is when we occasionally use options. Okay. And you can see them recently in 23 and 24, we use them a little bit more often because the volatility, the cost of using options has been relatively low. Right. And I mentioned that because it takes me to 23, which will bring me to today. In August 23, it's an example of one of those situations where volatility was low, but our model was telling us that there's a good chance that there's going to be an acceleration of volatility, right? The hedge ratio was around 5-6%. It was not a significant hedge ratio, but our volatility forecast was saying, there's a good chance it's going to be moving up. But it was also, when we looked at the market, the implied volatility was low. So the cost of buying options was relatively low. So at that point, we removed our hedge with the futures, which was a 5-6% hedge, and we put it using options, because options gives you a little bit more kicker if you get it right. But if you get it wrong, there's a cost to holding them. Okay, so that's why we make sure that if we buy options, we buy it at a time when they're inexpensive. And you can see here in August 23, so we put a small hedge on 5-6%. Early August, markets retreated, vol spiked a little bit. There's a bit of a drawback in Q3 of last year, early Q4, and we ended up selling the options late August and replacing it with a hedge in the future. So once the options have kind of done their job, increased in value, we'll sell them and replace them with a hedge on the future side. The reason I bring this I think this example is pertinent right now is because we're in a kind of a similar situation. There's been a lot of uncertainty. There's been a lot of noise. The elections have gone through. The market's been very happy about the elections. There's been a rotation in the market. So it's not all the sectors that have done well, but if you look at on an aggregate basis, the index has been relatively, other than the first couple of days when it went a little bit haywire, it's been ticking up in a very orderly manner. There's a lot of dispersion within the name. So some stocks are doing great and other stocks are not doing so well, but on an aggregate level, the market has just been kind of slowly ticking up. So our volatility measure is relatively low. Our hedge right now is relatively low. It's quite similar in the 5-6% range that you saw that you see back in August 23. The implied volatility, the price of options, was very expensive throughout the election and even after the election. And actually, in the last week or so, the price of the options, the implied volatility, has kind of started to move down from around 20% just post-election to around 13-14% this morning. So it's getting at a point which is quite similar to where we were late August, where markets are a little bit frothy, sure, but we're not there to predict where markets are going. However, our hedge ratio is saying the risk isn't significant, but it's a good time. It's looking like a good time, if the implied comes down a little bit further, to put that hedge on with options, which will provide a little bit more of a hedge if markets do correct. And that trade-off between the futures and the options now looks quite favorable. So that's kind of where we are. If I give you kind of a picture of what we're thinking about right now from a hedge perspective, the vol is relatively low. Our model is saying that it's getting a little bit tight though, and there's you get this feeling that there could be some acceleration to the upside in the vol. Right now we have this hedge with futures at around 5-6%, and we're looking towards potentially if the implied stays where it is or comes down a little bit further, adding a hedge or I should say shifting that hedge into the options market, which provides a little bit more of a downside protection. And given where markets are right now, my personal view is really not that important. I would call markets a little bit frothy right now, but I think I would have called them frothy a year ago. So that's why I don't pick stocks, and that's why I manage risk.
Yeah, that makes sense. But it kind of echoes. I mean, if you pair the two, an equity perspective with your risk perspective, I mean, they kind of mirror themselves, like equity being frothy and growth oriented right now, and your defensive strategy being, well, options are cheap and I can put some insurance on this now. They both kind of pair up nicely in terms of what we're hearing and what we maybe are trying to predict where things are going.
Absolutely. I think right now I think it's always good to have some kind of overlay, obviously, some kind of defensive overlay on it. But I think where markets are right now, it's particularly interesting to have this kind of feature. And again, it's a kind of feature where I think it's with PineStone and the type of approach that they have to stock picking. It's a very good marriage. The two go together very well, and it's about they have historically had anywhere from 3 to 5% over a cycle in terms of alpha. We don't want to touch that. That's fantastic. It's the beta that we're concerned with. It's how much beta risk are they carrying? How much is the volatility of the market? And so us being able to focus on that, so that their outperformance is relative to something that makes more sense for the investor in the event that there is a drawdown. That's where the two come together really nicely. And I think our focus is on the risk side. Risk forecasting risk. And it's a very cost efficient way to do it. So it means that Nadeem and his team can stay fully invested. We don't need to ask them to give us 10% of their capital because we're implementing a hedge strategy. They are 100% invested, and in fact, we could implement our hedge rate, our hedge strategy with minimal cash and just a little bit of stock lending on their behalf. So it's a very, very efficient way to do it, and it means that you get the full PineStone experience with a defensive kind of overlay on top of it.
And staying invested, I mean, is paramount there. And just going back to your earlier slides, Dave and I, work in that marketplace where we have to counsel clients at that time when they want to sell and want to go to cash or reduce their risk and their exposure. So having, defensive overlay to say, okay, here's your experience of what's happening in the markets right now. So you're okay. Like markets are down 30% and you're down 10. They're going to like that conversation, even though they don't like being down 10. If you can prove that, you're doing okay, stay invested, because when this thing chooses to take off again, like it did after COVID, it's best to be invested and be ready for that. So you miss out on those first few days, and your exposure and your experience in your portfolio is going to be a lot different than somebody who stayed invested.
No, absolutely. I think it's fundamental. I'm a firm believer that you have to accumulate capital over the long term. You need to stay in the market. But I think it's really important to remember that not everybody has that kind of multi-generational time horizon. Some people have the 5-10 year horizon. People are saving for a house, for retirement, and they're sensitive to the point in time when that drawdown happens. It's a pension fund will see that as an opportunity to buy. There's a drawdown, no problem. If they're still accumulating capital, it's just an opportunity to buy cheaper than it was two weeks ago. And they're going to be the payout is in 50 years time, so it's not an issue. But if you have a 5-year horizon, you're going to make a bad decision during that drawdown. Absolutely, and even a 10-year horizon. And it's you need to make sure that either you have you have the stomach to go through those ups and downs and and not pull the trigger, but unfortunately a lot of people don't. And I think it also has the benefit that in certain circumstances you end up ahead. If you could protect that drawdown and build off a stronger base, then from a compounding perspective, it makes a huge difference. And again, it's a minus 40 plus 40 gets you're down 16% on a compounded basis. If you just turn that into a minus 20 plus 20, you're down 4% on a you gain 12% just by reducing your volatility. The average of minus 40 plus 40 is 0. The average of minus 20 plus 20 is 0 as well. But not if you're compounding. Now there's a 12% differential, and I think that the fact that the people greatly underestimate the impact the changes in volatility have on their portfolio and the drawdowns have on the compounding of returns over the long term. So that's kind of that's what we focus on in this strategy, is really ensuring that path is smoother, and the smooth path has a ton of implications. Some of them being mathematical, that compounding is better, and others are behavioral, that you're not going to do something stupid if you've lost 20 when everybody else has lost 40. You're not feeling good because you're still down 20, but you're feeling much better than everybody else, and you're unlikely to make that poor decision.
You bet.
Yeah, I think. What else you got there?
Well, that's answering all of my questions in terms of what I came to hear. So.
Yeah, I think we've kind of got our questions done. Is there anything you want to add that we haven't asked you that you wanted to make sure gets out there?
No, I think we've touched upon most of the stuff that we want to. Like for us, again, the important thing is that this is a purely systematic strategy. So we're a team of quants. We don't particularly like to be called a quant, but that's what we are. We build models, and we don't let. This is not a fully autonomous model. We're not. The model is not sending trades into the market and without a PM being responsible for making sure that this makes sense. So we build a model, but we oversee the model, and it's the idea is to have something that's systematic, that doesn't rely on emotion, but that addresses specific issues that I think are fundamental for investors. And that is about managing the downside and making sure that investors stay invested. So that for us is key, and it's what we're doing is trying to get a little look into the future in terms of the risk. And there's a lot of empirical evidence that risk is sticky. These regimes in terms of volatility are quite sticky, and that there's a link between these regimes and returns that you're going to get. So we just want to use the information that's available to us in terms of risk and help position the overall portfolio so that you kind of you don't have unwanted surprises. And again, as I mentioned, the implementation for us is we're derivatives. We exclusively use derivatives in this. Sometimes derivative sounds like a scary word, but it's an extremely cost-effective way to implement the hedge. We're always removing exposure. So we're never adding additional risk. Everything we're doing is removing a risk that's already in the portfolio. All right. So there's in no way are we putting any additional sources of risk on the portfolio. Everything is about risk removal. The hedge ratio goes anywhere from -2, let's say, to -60. Most of the time, it's pretty close to that -5 range. We don't want to be removing exposure during quiet bull markets when everything's going great. But we want to be pretty damn close to the trigger when things start to move and start to look a little bit more risky. We want to be there to ensure that you're not carrying too much risk in the portfolio as you go through those periods of greater turbulence. So that's kind of that's our mindset. So if we're not doing much, it's that things are going well. But from time to time when we do pop up, it's hopefully it's when we're needed, and then it's to reduce those kind of drawdowns.
Well, that's great, Nick. I've really enjoyed speaking with you today. We thank you again for being here on Smokin' Bulls and enlightening us as to how you can take some risk off of these equity portfolios, but remain exposed to the performance that you want to achieve. So it's been great speaking with you. And Wayne, we want to thank you again for helping pull this podcast together. It's great having your support and Canoe's support. If our viewers want to learn more, they can always head over to Canoe Financial's website and check it out there and poke around. But they also can reach out to Dave and I at towerwealth.com. So thanking everybody for tuning in and catching us here on Smokin' Bulls. If you want to learn more about us, check out our socials and catch us online. So thanks, everyone, and we'll hope to see you all again soon.
Thank you very much, Dave, Tyler. Appreciate it.
Thanks, guys.
You got it. Have a good day.